There is a question that has sparked countless debates whenever people talk about money. Is the stock market investing, or is it simply gambling dressed up in a more sophisticated way? Some people believe the stock market is one of the most powerful wealth building tools ever created. Others look at people who lose their savings, chase hot stocks, borrow money to trade, and stare at price charts all day, and they come to a very different conclusion. To them, the stock market looks a lot like a casino. So who is right? The answer is more complicated than most people think. The stock market itself is not gambling, but the way you participate in it can absolutely turn it into gambling. Two people can buy exactly the same stock at exactly the same price. One person may be investing while the other is gambling. The difference isn't the stock. It isn't the trading app. It isn't even the amount of money they put in. The real difference is why they bought it, what they understand, how they manage risk, and what they will do when things don't go according to plan. Imagine two people opening a brokerage account. The first person spends time researching a company. He wants to understand how the business makes money, who its customers are, whether revenue is growing, whether the company is profitable, whether it carries too much debt, whether it has a competitive advantage, and whether management can be trusted. After doing his research, he decides to buy the stock because he believes the business can grow over the long term. The second person sees a stock exploding on social media. Everyone is talking about it. People are posting screenshots of huge profits. Videos are claiming that this could be the next massive opportunity. The stock has already gone up dramatically, and he starts feeling like he's about to miss out. He doesn't know what the company actually does. He doesn't know how much money it makes. He doesn't know how much debt it has. He doesn't know whether the business is profitable. He knows only one thing: the price is going up, so he buys. Both people purchased the same type of asset, but they're playing two completely different games. The first person is trying to own part of a business. The second person may simply be betting that someone else will buy his shares at a higher price. And this is where the line between investing and gambling begins. Investing means putting money into an asset because you believe that asset can create value over time. When you buy shares of a company, you're buying a small piece of ownership in that business. If the company grows, sells more products, increases profits, and becomes more valuable, your ownership can become more valuable as well. The business is actually operating. It has employees, it has customers, it sells products or services, it generates revenue, and hopefully, it generates profits. Behind your investment is a real economic machine. Gambling is different. In gambling, you typically put money on an uncertain outcome and hope that outcome goes in your favor. You guess correctly, you win. You guess incorrectly, you lose. But here's the problem. The stock market is also full of uncertainty. You can research a company for months and still lose money. You can invest in an excellent business and still watch its stock price fall. A recession can suddenly happen. Interest rates can change. A new competitor can appear. Technology can disrupt an entire industry. Nobody can predict the future with perfect accuracy. So if investing also involves uncertainty and risk, how is it different from gambling? The difference isn't whether risk exists. Both involve risk. The difference is where the potential return comes from and how you deal with uncertainty. In many forms of gambling, the system is designed so that the house has an advantage over time. You may win occasionally, but the longer you play, the more the mathematical advantage works against you. That's why a casino doesn't need to win every single hand. It only needs the probabilities to remain in its favor across thousands or millions of games. A gambler might win tonight. The casino looks at the long run. But when you invest in assets capable of creating value, you're not necessarily participating in a game where a house is taking a built-in advantage from every decision you make. You can benefit from economic growth. A business can expand. Profits can increase. Products can improve. Productivity can rise. The economy itself can create more value over time. None of this guarantees that every investment will succeed. It absolutely does not. But there's a fundamental difference between owning part of a business that creates value and repeatedly participating in a game designed to give the house a mathematical edge. However, this is where things get dangerous. The moment you stop thinking about value and start thinking only about price, the stock market can begin to feel like a casino. You stop asking, what is this company actually worth? Instead, you ask, will it go up tomorrow? You stop researching businesses. You start staring at candlestick charts. You stop thinking in years. You start thinking in minutes. You don't care what the company sells. You care only whether the stock is green or red. And slowly, sometimes without realizing it, you've turned investing into gambling. There is nothing magical about owning stocks. Owning stocks doesn't automatically make someone an investor. Just as owning a guitar doesn't automatically make you a musician, opening a brokerage account doesn't automatically make you an investor. What matters is how you use the tool. You can use the stock market to slowly build wealth over decades, or you can use it to destroy your financial situation in a matter of months. The same market can produce both outcomes. One of the biggest reasons people confuse investing with gambling is that the market can sometimes reward bad decisions. This is one of the most dangerous psychological traps in finance. Imagine someone who knows almost nothing about investing. One day, he hears that a certain stock is about to explode. He does no research. He buys simply because everyone else is excited. Then something incredible happens. The stock rises. He makes money. What does he learn from that experience? Unfortunately, he may learn the wrong lesson. Instead of thinking, I got lucky, he starts thinking, I'm good at this. The next time, he invests more money. He wins again. His confidence grows. He starts believing that he understands the market. He begins to feel smarter than everyone else. But sometimes, a rising market can make almost anyone look like a genius. When everything is going up, even bad decisions can produce good results. That doesn't mean the decision was actually good. The environment may simply have been favorable. Eventually, the market changes. The stock starts falling. For the first time, he loses money. But instead of asking whether the original decision was wrong, he tells himself that the stock will recover. So he keeps holding. The stock falls further. He buys more. He tells himself he's getting a bargain. The price keeps falling. The loss becomes larger. And then something important happens inside his mind. He's no longer trying to make money. Now he's trying to get back the money he lost. This is one of the most dangerous moments for any investor or trader. Because from this point forward, decisions are often no longer based on logic. They're based on pain. He no longer asks whether the investment still makes sense. He doesn't ask whether the company is still worth owning. He thinks about one thing: getting his money back. But the market doesn't know what price you paid. The market doesn't care how much money you've lost. The stock doesn't know that you need it to rise. The market doesn't owe you anything. And this is where investing can become psychologically similar to gambling. A gambler who loses money may think, I just need one more win. An inexperienced investor may think, I just need the stock to get back to my purchase price. Both can become trapped by the same psychological problem. They're no longer making decisions based on the future. They're making decisions based on the past. Another reason the stock market can become dangerous is that it gives you constant feedback. The market gives you a score every day, sometimes every second. Your account is green and you feel good. Your account is red and you feel terrible. You wake up and check prices. You check again during lunch. You check before bed. You may even wake up in the middle of the night to check again. Your emotional state begins moving with the market. When your stocks rise, life feels great. When they fall, anxiety takes over. At this point, you need to ask yourself an uncomfortable question. Are you investing or are you chasing a feeling? A real investment doesn't necessarily require you to look at it every few minutes. If your investment thesis is based on what a company can accomplish over the next several years, a small price movement over a few hours shouldn't completely change how you view the investment. Of course, you should monitor your investments. You should pay attention to important changes. But monitoring isn't the same as obsessing. One of the clearest signs that investing is turning into gambling is when you start making decisions primarily based on emotion. You buy because you're excited. You sell because you're afraid. You buy because everyone else is buying. You sell because everyone else is selling. You don't have a plan. You're simply reacting. And the market is extremely good at punishing people who constantly react emotionally. You buy after the price rises because you're afraid of missing the opportunity. Then the market falls. You panic and sell. After you sell, the price recovers. You regret your decision. So you buy again at a higher price. Then the market falls again, and the cycle repeats. You buy with greed. You sell with fear. And slowly, trade by trade, your emotions take control of your money. The stock market doesn't have to deceive you. Your own psychology can do it for you. This brings us to one of the most powerful forces in modern investing, the fear of missing out. Fear of missing out is incredibly powerful because it makes patience feel like a mistake. You see other people making money. You see screenshots of huge gains. You see expensive cars. You see people claiming they've discovered the next big opportunity. Suddenly, doing nothing makes you feel like you're losing. You start thinking, what if they're right? What if this stock doubles? What if I miss the biggest opportunity of my life? And that fear pushes you into decisions you would normally never make. But there's something social media rarely shows you. For every person posting a winning trade, there may be many others quietly losing money. People love showing their victories. They rarely post screenshots of their worst mistakes. Someone may show you one successful trade, but not the dozens of failed trades that came before it. Someone may show you a profit without showing you how much risk they took to earn it. Someone may make a huge return on one position while actually risking their entire financial future. From the outside, success can look exactly like skill. But sometimes it's simply luck combined with extreme risk. That's why you should never confuse a successful outcome with a good decision. Someone can make money from a terrible decision. Someone else can temporarily lose money from a reasonable decision. A single outcome doesn't tell you the quality of the process. A better question is, did you have a rational reason for making that decision? Did you understand the risk? If you were placed in the exact same situation again, would you make the same decision? These questions matter far more than whether your last trade made money. Now let's talk about the difference between investing, speculation, and gambling. Investing asks a simple question: what is this asset actually worth? And what value can it create over time? Speculation asks a different question: where might the price go next? Gambling often asks an even simpler question: can I win quickly? These activities can overlap, but the mindset behind them is very different. An investor focuses primarily on value. A speculator focuses primarily on price movement. A gambler focuses primarily on the outcome. That doesn't mean speculation is always bad. There are professional traders who use carefully designed systems, probabilities, and risk management. They're not simply guessing, but someone buying and selling based on rumors, excitement, panic, and social media hype doesn't automatically become a professional trader. Calling yourself a trader doesn't make your decisions intelligent. A gambling mindset can exist inside a brokerage account just as easily as it can exist inside a casino. Another important difference between investing and gambling is how you respond to being wrong. A gambler often thinks, I have to win. A good investor understands something much more important: I can be wrong. That sounds simple, but it changes everything. If you believe you cannot be wrong, you'll accept enormous risks. You'll put too much money into one idea. You'll refuse to sell when new evidence appears. You may borrow money because you believe the outcome is certain. You'll treat uncertainty as if it doesn't exist. But experienced investors understand that uncertainty never disappears. No matter how much research you do, there are things you simply cannot know. That's why risk management exists. Risk management isn't about perfectly predicting the future. It's about being able to survive when your prediction is wrong. And in investing, the ability to survive is one of the most underestimated skills. You don't need to win every decision. You don't need to find the next stock that increases by hundreds of %. You don't need to predict the exact bottom. You don't need to predict the exact top. But you do need to avoid mistakes that could permanently destroy your financial future. Think of the stock market like a very long journey. The person who moves fastest at the beginning isn't necessarily the person who reaches the destination. Sometimes the person who survives is the one who wins. If you lose a small amount of money, you can recover. If you lose everything, recovery becomes much harder. That's why one of the smartest questions you can ask before investing isn't, how much can I make? It's, what happens if I'm wrong? How much could I lose? Can I afford that loss? Could this decision affect my ability to pay for everyday life? Am I using money I actually need? Am I borrowing money to take this risk? If the investment goes badly, can I survive financially and emotionally? These questions aren't exciting, but the goal isn't excitement. The goal is financial survival. This is another major difference between an investor and a gambler. A gambler often looks at the potential reward first. An investor looks at the potential risk first. A gambler asks, what if I win? An investor asks, what if I'm wrong? That single change in thinking can completely transform the way you manage money. Now let's talk about one of the most dangerous things in the stock market: leverage. Leverage is a financial tool. Like many tools, it can be useful when someone understands how to use it, but extremely dangerous when used without experience. The problem begins when people use leverage because they want to become wealthy faster. Imagine someone who has only a small amount of capital. He's frustrated because his potential returns feel too slow. So he borrows money or uses leveraged products to increase the size of his position. If he's right, the profits can come very quickly, and that success can become addictive. But if he's wrong, the losses can grow much faster too. The market doesn't care that you borrowed money. The market doesn't slow down because you've taken too much risk. A small mistake can become a major financial disaster. And this is where many people make a critical mistake. They believe that because leverage helped them win once, they understand how to control it. But sometimes winning doesn't prove that you understand the risk. It simply proves that you were right that time. The market can reward reckless behavior for a while. Eventually, however, risk has a way of revealing itself. Another psychological trap is revenge trading. Imagine you lose money. Instead of stopping, taking a break, and reviewing what happened, you immediately place another trade. But this time, you use more money. You're angry. You want your money back. You're no longer making a financial decision. You're trying to defeat the market emotionally. But the market isn't your enemy. It doesn't know your name. It doesn't know how much you've lost. It isn't deliberately attacking you. When you start trading simply to recover a previous loss, you may have crossed the line between rational decision-making and gambling behavior. The most important decision often isn't the first trade. It's what you do after the trade goes wrong. One person loses money, accepts the mistake, studies what happened, and improves. Another person loses the same amount and immediately doubles the size of the next bet. The first person protects his future. The second person may destroy it. The difference isn't necessarily intelligence. It's often emotional control. And emotional control may be one of the most valuable financial skills anyone can develop. So can you invest without becoming obsessed with the market? Absolutely. But it requires a shift in mindset. You need to stop treating every price movement as a personal emergency. You need to understand that volatility is part of investing. A falling stock price doesn't automatically mean you made a bad decision. A rising stock price doesn't automatically mean you made a good decision. You have to look deeper. What's happening to the business? Has the company changed? Has your original investment thesis changed? Are the risks different now? Are you still comfortable with the amount of money you have invested? These are far more useful questions than simply asking whether the chart is green or red. A mature investor doesn't try to prove that they're always right. They try to make the best possible decision based on the information available. And when new information appears, they're willing to change their mind. There is no reward for holding a bad investment forever. There is also no reward for selling a good investment simply because you became impatient. The goal isn't to be loyal to a stock. The goal is to make rational decisions because a stock isn't your friend. It isn't your identity. You don't need to defend it online. You don't need to convince everyone that you're right. Your financial future doesn't depend on winning an argument. It depends on managing your money intelligently. And perhaps one of the biggest lessons is this: don't confuse luck with skill. You can make money from a bad decision. You can lose money from a good decision. A single outcome doesn't prove very much. Imagine walking into a casino and placing a completely random bet. You win. Does that mean you've discovered a brilliant investment strategy? Of course not. But people make exactly this mistake in the stock market. They buy something based on a rumor. It rises. They make money. Suddenly, they believe they've figured out how the market works. That confidence can be more dangerous than the original mistake, because next time they'll risk more money. Eventually, the market may teach them an expensive lesson. The best investors aren't necessarily the people who believe they're always right. They're the people humble enough to understand that they can be wrong. When they make money, they ask, was that skill, luck, or both? When they lose money, they ask, what can I learn from this? That mindset creates progress. Blaming everyone else doesn't. So let's return to our original question one final time. Is the stock market gambling or investing? The stock market can be investing. It can also become speculation. And yes, it can absolutely become gambling. The difference largely depends on how you participate. If you buy stocks because you understand the business, believe it has long-term value, understand the risks, allocate your capital responsibly, and invest money you can leave alone for a long time, you're approaching the market with an investor's mindset. But if you buy because someone online promises huge returns, if you don't know what the company does, if you're constantly chasing price movements, if you borrow money to make bigger bets, if you keep trading just to recover losses, and if your mood depends on whether your account is green or red, then you may not really be investing. You may simply be gambling through a different interface. The stock market isn't automatically a wealth-building machine, but it isn't automatically a casino either. It's a tool. And like any powerful tool, it can be used wisely or recklessly. You can use it to slowly build wealth, or you can use it to make impulsive decisions and destroy years of hard work. The choice isn't always easy because the market is designed to trigger powerful emotions: greed, fear, hope, regret, excitement, and panic. Those emotions can make intelligent people behave irrationally. That's why knowledge matters. But knowledge alone isn't enough. You also need discipline. You need patience. You need risk management. And perhaps most importantly, you need to understand yourself, because your biggest enemy in the stock market may not be another investor. It may not be Wall Street. It may not be a hedge fund. Sometimes, your biggest enemy is the person looking back at you in the mirror. So before you buy your next stock, stop for a moment. Ask yourself why you're buying it. Do you understand what you own? Do you know what could happen if things go wrong? Are you prepared for volatility? Are you investing money you can actually afford to put at risk? Or are you simply hoping to get rich quickly? Because the answers to those questions may determine whether the stock market becomes a tool that helps build your future or a casino that quietly destroys it. And if you've made it this far, you're already asking the right kind of questions. At Money Decoded, we believe understanding money isn't just about learning how to make more of it. It's about understanding the psychology, systems, and decisions that determine what happens to it. If you want more videos that break down investing, wealth, financial psychology, and the hidden rules of money in a simple and practical way, subscribe to Money Decoded. And if this video made you rethink the difference between investing and gambling, share it with someone who needs to hear this message. The stock market doesn't decide whether you're an investor or a gambler. You do. Before you put your money into the next opportunity, ask yourself one final question. Am I investing in the future, or am I simply betting on tomorrow? This is Money Decoded. Understand money, understand the game.